Investing in the stock market can be a great way to build wealth and achieve financial freedom. However, it can also be a risky and complicated endeavor if you don't know what you're doing. With the rise of digital trading platforms, investing in the stock market has become more accessible than ever before. In this video, we will explore some tips on how to make money with the stock market in 2023. Invest in companies you believe in. Investing in companies that you believe in can provide both financial returns and a sense of satisfaction. When you invest in companies whose products or services you use or believe in, you are more likely to hold on to your shares for the long term, even during market downturns. Some examples of companies that people believe in include Tesla, Amazon, and Apple. When selecting companies to invest in, it's important to look for those with a solid track record of financial performance, good management, and a competitive advantage in their industry. This will increase your chances of success in the stock market. Do your research. Before investing in any company, it's important to do your research. This means going beyond the headlines and reading the company's financial statements, understanding their business model, and analyzing their competitive landscape. You should also consider macroeconomic factors that could impact the company's performance, such as changes in interest rates or government regulations. Some financial metrics to look at include revenue growth, earnings per share, return on equity, and debt-to-equity ratio. You should also read the company's quarterly and annual reports, as well as analyst reports, to get a sense of how the company is doing. Diversify your portfolio. Diversification is key to reducing your risk when investing in the stock market. This means investing in a variety of companies across different sectors and geographies. By diversifying your portfolio, you can reduce your exposure to any one company or sector and protect yourself from market volatility. One way to diversify your portfolio is to invest in exchange-traded funds, ETFs, that track a specific sector or index. For example, you could invest in an ETF that tracks the S&P 500, which is a broad index of 500 large-cap U.S. stocks. Another option is to invest in international stocks or emerging markets, which can provide exposure to different economic cycles and growth opportunities. Invest for the long term. Investing in the stock market should be viewed as a long-term strategy. While there may be opportunities for short-term gains, it's important to remember that the stock market can be volatile in the short term. By investing for the long term, you can ride out market fluctuations and benefit from the compounding effects of your investments. To invest for the long term, you should have a clear investment plan that aligns with your financial goals and risk tolerance. You should also be prepared to weather market downturns without panicking or making impulsive decisions. Consider investing in index funds. Index funds are a great way to invest in the stock market without having to pick individual stocks. These funds track a particular stock market index, such as the S&P 500 or the Nasdaq Composite, and offer exposure to a broad range of companies. They also typically have low fees, making them a cost-effective way to invest in the stock market. One benefit of investing in index funds is that they provide instant diversification, since they hold a large number of stocks across different sectors. They also tend to outperform actively managed funds over the long term, since they don't incur the high fees associated with active management. Avoid emotional investing. Emotional investing can be one of the biggest pitfalls for new investors. This means making investment decisions based on fear or greed, rather than sound financial analysis. It's important to avoid making knee-jerk reactions to market movements and instead focus on your long-term investment strategy. One way to avoid emotional investing is to have a clear investment plan and stick to it. This means setting investment goals, determining your risk tolerance, and creating a diversified portfolio that aligns with your investment objectives. You should also avoid trying to time the market, since this can lead to missed opportunities and higher trading fees. Another way to avoid emotional investing is to ignore the noise of the financial media. While it's important to stay informed about market trends and news, you should avoid making investment decisions based on headlines or rumors. Instead, focus on fundamental analysis and research to make informed investment decisions. Use dollar cost averaging. Dollar cost averaging is a strategy that involves investing a fixed amount of money at regular intervals, regardless of market conditions. This means that you buy more shares when prices are low and fewer shares when prices are high, which can help reduce the impact of market volatility on your portfolio. For example, if you invest $1,000 per month in a particular stock or ETF, you will buy more shares when the price is low and fewer shares when the price is high. Over time, this can help reduce the average cost of your investments and increase your overall returns. Consider working with a financial advisor. If you are new to investing or don't have the time or expertise to manage your own portfolio, you may want to consider working with a financial advisor. A financial advisor can provide personalized investment advice and help you create a portfolio that aligns with your financial goals and risk tolerance. When selecting a financial advisor, it's important to choose someone who is transparent about their fees and has a fiduciary duty to act in your best interest. You should also look for someone with relevant experience and certifications, such as a certified financial planner, CFP, or a chartered financial analyst, CFA. In conclusion, making money with the stock market in 2023 requires a combination of research, patience, and discipline. By investing in companies you believe in, diversifying your portfolio, investing for the long term, and avoiding emotional investing, you can increase your chances of success in the stock market. Additionally, using strategies such as dollar-cost averaging and working with a financial advisor can help you achieve your financial goals and navigate the ups and downs of the stock market. Thank you for taking the time to watch this video, and we hope that the tips and strategies outlined in this article will help you make informed investment decisions and achieve your financial goals. Remember to always do your research, diversify your portfolio, invest for the long term, and avoid emotional investing. And if you found this video helpful, please don't forget to subscribe to our channel for more informative content.